If a trade feels comfortable, there is a good chance you are standing on the wrong side of it. Comfort means the move is already obvious. The chart has already made its case, and everyone looking at that screen has reached the same conclusion you just did. All of those traders have to be positioned somewhere, and someone with more capital and more patience is quietly taking the other side of them. David Paul compressed decades of professional trading into 3 rules. The good trade is a hard trade. Fade the short-term trend in the direction of the long-term trend. Place your entries where the masses put their stops. 3 sentences from a trader who felt these behaviors long before anyone modeled them. And in this video, we rebuild each one with Smart Money and ICT concepts to expose the structural logic underneath. Here on the ComLucro channel, our mission is to connect classical trading wisdom with modern institutional logic. So we will organize these rules around 3 questions you should answer before any entry. Direction: what the higher time frame is actually doing. Location: where inside its range price is trading right now. Liquidity: whether the crowd has already been taken out. By the end of this video, you will not only understand where to enter, but why those entries work, and how they align with smart money behavior in real market conditions. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Before we open a single chart, let us start with the first rule, because it is the one that decides whether you ever get to use the other 2. Over the years, experienced traders have distilled what they know into principles that sound almost too basic to matter. Behind them sits a level of structural understanding that most traders never develop. Listen to how David Paul describes the first one, and notice that he is not talking about analysis at all. He is talking about what it feels like to press the button.
Rule number 1, the good trade is a hard trade. You know who taught me that? A delightful old man. He was one of the first market wizards, Michael Steinhardt. Do you know him, Larry? I know him so well. He's 90 these days, 91. He's still trading. My word, he's made a hemp. He trashed those indices for 25 years. And he was the inspiration for me, in fact, buying oil right at the lows. That was a classic Michael Steinhardt trade. And please Google Michael Steinhardt. He was one of the original market wizards. He has got cast iron you-know-whats in his day. He was something. Guys, the good trade's a hard trade. I'm not saying it's intellectually difficult, okay? In fact, as I said on Friday, the thicker you are, the better. But it's just difficult to do. The market's roaring down, 3 big red bars. Puts the fear of God into you, and now some idiot tells you you must step in and buy it. It's really, really difficult, okay? Very difficult to do. So that's a characteristic of a good trade. If the trade seems easy, there's a good chance you're just about to be sexually violated. And that's fine if you like that sort of thing.
What makes a trade feel hard is not randomness, and it is not bad luck. It feels hard because price is doing something very specific right before the real move begins. And in most cases, that discomfort comes from liquidity being engineered in the market. Notice the mechanism he describes. 3 big red bars, and suddenly your read of the entire trend changes. That is recency bias doing its work, letting the most recent candles overwrite everything the structure told you for the 200 before them. The move that scares you out is not evidence against your idea. It is the cost of collecting the orders needed to fund the move you were waiting for. So before we go any further, you need to understand how liquidity actually works and why price has to sweep it before it can travel with momentum. Looking at this schematic figure, it shows a rally wave moving upward, sweeping the external liquidity gathered above the previous high. After this, the price shifts toward internal liquidity, indicated by this fair value gap, to fill the gaps left behind from internal liquidity. The price then transitions back to the external phase. Essentially, the price moves from the fair value gap to external liquidity by sweeping the liquidity above this high. With the external liquidity swept, the price then aims to balance by targeting internal liquidity. This causes the price to drop and fill the most recent fair value gaps. Shifting our focus, let's examine the details of static liquidity. Static liquidity refers to specific zones in the market where a large pool of money is resting, such as stop losses or buy and sell orders. When a trader gets stopped out of a position, the market absorbs the funds associated with that stop loss. Recognizing a liquidity sweep pattern before the price reaches our point of interest is crucial. This pattern confirms the strength of our supply or demand area. We use liquidity sweeps as a confirmation factor. The idea is simple. The market requires liquidity for momentum. If the price doesn't sweep liquidity before a key level, it often uses that zone as liquidity to fuel its momentum. Understanding that price seeks liquidity explains the movement, but there is another layer that makes this even more deceptive. Sometimes price does not simply sweep and go. It builds the illusion of continuation first, so traders commit before the real move unfolds. This is where confirmation bias becomes expensive. A clean break of structure is not only information, it is permission. The moment the chart agrees with what you already wanted to do, you stop checking. You stop measuring the retracement, you stop asking where the stops are resting, and you take the entry because it looks valid. Most traders are not trapped here by something invisible. They are trapped by something that looked exactly right. At its core, inducement is the process of creating liquidity before the real move takes place. It represents the final pool of liquidity engineered to fuel the intended move, and it can appear in several different forms. The most common are structural inducement, liquidity-based inducement, and time-based inducement. Let's begin with structural inducement. Among all these variations, structural inducement is arguably the most important because it occurs directly within market structure and creates patterns that traders encounter almost every day. A structural inducement happens when price generates a false structural signal, such as a fake change of characters or a misleading break of structure, encouraging traders to enter too early or position themselves in the wrong direction. In this example, price is trending higher and continues producing bullish breaks of structure to the upside. However, when we focus on the most recent break of structure, everything initially looks completely legitimate. Price breaks above the swing high and closes beyond it. Naturally, this leads many traders to anticipate buying opportunities at the demand zone or order block responsible for that break. Then the result becomes obvious. You enter the buy position, and price quickly stops you out. This is a classic example of how structural inducement traps the majority of market participants. The reason becomes much clearer when we take a deeper look at what actually happened. This so-called break of structure was never a genuine break of structure in the first place. The entire move was driven by resting buy-side liquidity located below, inside the discount zone of the primary bullish leg. If you draw your Fibonacci tool from the swing high down to the swing low, you will notice that price never even retraced to the 38.2% level, let alone the 50% level of the previous impulse. This observation is extremely important. For us at ComLucro, any retracement that fails to reach at least the 38.2% level should not be considered a valid retracement. And even when price reaches only the 38.2% level, these shallow pullbacks often lead to inducements and liquidity grabs rather than clean, high-probability entries. Because of this, traders should always approach shallow retracements with caution. In a bullish trend, the preferred scenario is to wait for price to retrace toward the 50% level or even deeper, where price enters the discount zone. This is where institutional buying activity is more likely to be present and where you reduce the risk of becoming liquidity for inducement-driven moves. Understanding this concept allows you to avoid false structure breaks, identify liquidity-driven pullbacks more effectively, and remain aligned with the true direction of the market instead of getting caught in inducement traps. Once you understand how structural inducement traps traders, the next logical step is to identify where the real opportunity forms after that failure. When a valid-looking break turns out to be false and liquidity has been collected, the market leaves behind a very specific footprint. That footprint is uncomfortable to trade, and there is a reason for it. The level that just betrayed you is the level that is about to work. Your mind resists holding those two ideas at once, and that friction is cognitive dissonance. So the easy escape is to dismiss the level entirely and look for a cleaner one somewhere else. Structure carries no such memory. It only records that supply and demand have swapped roles at that price. The concept is straightforward. A failed order block turns into a breaker block while a fair value gap forms in the same zone. When these align, they create a high confluence area where price often retraces before continuing or reversing with precision. The strategy is based on three core elements: market structure, breaker blocks, and fair value gaps. Together, they explain how liquidity events and failed overflow lead to repeatable high-probability trade entries. Let us start with the breaker block. A breaker block forms when a valid order block fails and flips into a new supply or demand zone on the chart. In basic price action, we already know this behavior well. When price breaks through support, that same level often acts as resistance later, simply because of how traders react to it. The same principle applies to order blocks. An order block can fail due to a shift in market structure, an overextended price, or price tapping into an important higher time frame level. When a demand order block fails to hold and price breaks through it, that area flips into supply. This flipped zone is what we call a breaker block, and it becomes an area where we expect price to react and reject. Now let us talk about fair value gaps. Fair value gaps are also treated as supply or demand zones because they represent imbalance in the market. When a bearish fair value gap appears, it shows that selling pressure has clearly outweighed buying pressure, often driven by institutional activity. This creates market inefficiency, and price usually returns to that area to rebalance. When price revisits the fair value gap and there are still unfilled orders inside the zone, it creates an opportunity to trade in the direction of the existing momentum. That is when we often see price reject from the fair value gap and continue moving with strength in the same direction. It is important to keep one thing in mind. Fair value gaps must be unmitigated to remain valid. When a breaker block overlaps with an unmitigated fair value gap, this alignment creates a high-quality trading zone. When price returns to this area, the probability increases that it will behave as a strong supply zone and push price lower. In this situation, the entry is taken at the start of the zone, the stop loss is placed above it, and targets are set at the next key area ahead of price. The same logic applies in bullish scenarios, just in the opposite direction. Now let us look at a practical example using the euro-dollar on the 5-minute chart. We focus on the top of a recent impulsive move where a fair value gap has formed. The candle that created this gap can also be seen as an order block, marking a demand zone that would normally support price and push it higher. If price retraces into this zone, the expectation is usually a bullish rejection and continuation. But when price returns and breaks through the zone without holding, that demand area fails and flips its role. At that point, it becomes a breaker block. The bearish move that breaks below this former demand zone also creates a bearish fair value gap, signaling strong downside momentum. On their own, both the breaker block and the bearish fair value gap are meaningful areas. But when these two zones overlap, they create a high confluence trading zone. This overlap significantly increases the importance of the level and makes it a key area to watch for a strong market reaction. High confluence areas are zones where multiple price action signals come together, which naturally makes them more reliable. When different concepts align in the same area, more traders pay attention to that level. Because of this shared focus, these zones often trigger stronger and cleaner market reactions. That is why they become key areas where traders prepare, anticipate, and execute their trades. For the entry, The approach is straightforward. Place your sell limit order at the beginning of the high confluence zone and position your stop loss above the zone to protect against unexpected moves. When defining targets, aim for a healthy risk-to-reward ratio, such as 1:2 or 1:3, always based on the next important market structure levels ahead of price. To manage the trade more efficiently, one simple technique is to reduce risk once price reaches a 1-to-1 target. At that point, you can close half of the position and move the stop loss to break even. This way, even if price reverses and hits your stop, the trade does not result in a loss. At the same time, the remaining position is free to run in profit, allowing you to stay calm and focused while the market does the work. What we just saw is a precise example of how structure fails, liquidity is taken, and a high-quality zone forms for execution. But this type of setup does not exist in isolation. It only means something when it agrees with the broader direction of the market. That brings us to the first of our 3 questions, and to the second rule, because a perfect zone in the wrong direction is just a slower loss.
Rule number 2, I want to fade the short-term trend in the direction of the long-term trend. So fade the short-term trend in the direction of the long-term trend. So what I'm saying is that I've got a long-term trend in place and I want to buy a pullback and let it go again. Guess what that is? A, B, plus it's C, D. Okay, so I wonder where I got that from.
What he is describing is simple in theory, but powerful in practice. When the higher time frame shows a clear trend, you do not chase price at the extremes. You wait for a temporary pullback against the dominant direction, and then you position yourself in alignment with the larger trend. In other words, you trade the correction, not the impulse. The difficulty is that the impulse is where everything feels best. Momentum is visible, the move is confirmed, and standing aside feels like watching the trade leave without you. That is chasing, and it is the most expensive way to be right. Right about direction, wrong about price, with a stop parked so far away that the first normal pullback removes you. To wait for that pullback, you need a definition of direction that does not depend on how the last few candles made you feel. That definition is market structure. Now, let's get started with the market structure. The behavior of market movements can fundamentally be attributed to 2 main factors that consistently dictate the direction of prices: trends, which encompass both uptrends and downtrends, and the consolidation phase, characterized by choppy or ranging markets. Picture this as a perpetual cycle, where prices continuously oscillate between downtrends, uptrends, and consolidation periods, each gathering liquidity and institutional orders. Typically, prices need to consolidate following uptrends and downtrends. A vital initial step when analyzing your charts is determining whether the market is currently experiencing an uptrend, a downtrend, or is in a consolidation phase. To build a robust understanding, let's start with a straightforward overview of market structures before exploring the intricate details of advanced market dynamics. Consider an idealized version of a market structure reflecting a perfect uptrend. I term this as ideal because it's rare to encounter an uptrend in real markets that follows this pattern precisely. Markets don't usually move with such predictability. Nevertheless, to enhance our understanding of uptrends, let's examine this ideal model before shifting our focus to the more realistic uptrend structures that are more commonly observed. In a typical uptrend, prices will consistently create higher highs and higher lows. The pattern generally sees prices surpassing previous highs while sustaining the lows. An uptrend concludes when there is a break below one of the significant lows. To preserve the continuity of an uptrend, it's essential that these major lows remain unbroken. Additionally, when a price exceeds a major high, it results in a structural break and forms a demand zone, indicative of a break of structure, or BOS. Accurately identifying major highs and lows is crucial because it allows us to recognize signals for potential trend reversals or continuations. Without correctly pinpointing these key points, traders are at risk of misinterpreting market signals and potentially entering trades on the wrong side of the market. These principles are equally applicable in bearish scenarios. During downtrends, prices consistently form a sequence of lower lows and lower highs. In such scenarios, prices tend to break below previous lows while still respecting the previous highs. Let's explore the details of a realistic market structure, focusing on the more commonly observed uptrend patterns in the market. Consider a scenario where the price surpasses previous highs, breaking upward. At this juncture, a key question emerges. How do we pinpoint valid major highs and lows? To address this, let's examine the left side of the market structure. It is evident that the price underwent an upward trajectory until it began to retrace. The peak reached before this retracement is deemed the major high. Conversely, the lowest point during the bullish wave that triggered this upward movement and led to a break of structure and a new high is recognized as the major low. These 2 points are the critical external structures of the market, and any structure that develops between them is considered an internal structure. When the price surpasses the major high, marking a break of structure, BOS, it indicates a continuation of the upward trend. On the other hand, if the price drops below the major low, this should be interpreted as a signal of a trend reversal. The internal price actions within these external structures are secondary, provided the price stays above the most recent major low. Maintaining this condition signals that the market remains in a bullish phase. You might wonder why this low at the extreme is treated as the major low. The reason is that it represents the ultimate low point before the price starts its upward trajectory. This particular point is essential as it's the pivotal low that catalyzed the upward movement and the subsequent break of structure. Once direction is clearly defined through structure, the next question becomes location. Knowing that the market is bullish or bearish is not enough because not every level inside a trend offers the same opportunity. Location is also where comfort misleads you most directly. Price feels strongest when it is most expensive, at the top of its range, after a long run with every recent candle proving the move works. That feeling is not analysis, it is extrapolation, and it puts you long exactly where your stop has to be widest and your reward is smallest. Premium and discount replace that feeling with a measurement and answer the one question your eyes cannot answer alone. Is this price cheap or expensive relative to the range it is actually trading in? So, traders, what is premium and discount in the ICT methodology? And why does it matter when analyzing price inside a range? Within the ICT framework, price is not equally attractive at every level of the market. The location of price inside the range matters, especially when looking for higher probability entries and better risk to reward opportunities. That is where the concepts of premium and discount become important. But before we understand these zones correctly, we first need to understand what a trading range actually is. A trading range is simply the space between a swing low and a swing high in a bullish scenario, or between a swing high and a swing low in a bearish scenario. These swing points define the boundaries within which price is currently moving. Now, let us begin with a bullish example and understand how the trading range is drawn on the chart. In a bullish scenario, the trading range should be drawn using the Fibonacci retracement tool, with the 0 level placed at the swing high and the 1 level placed at the swing low. This means the upper boundary of the range is defined by the swing high, while the lower boundary is defined by the swing low. Once the range is established, the area above the 50% level becomes the premium zone, while the area below the 50% level becomes the discount zone. These zones help traders evaluate where price is positioned within the current market structure. Once the trading range is established, if price moves higher and breaks above the previous swing high, this creates a break of structure, confirming bullish continuation. On the other hand, if price continues moving lower instead of breaking higher, the market may begin forming a change of character. So, the key idea is understanding the sequence inside the trading range. First, the range is established. Then, a retracement forms. From there, the market reaches a decision point. Once price breaks above the trading range, we begin identifying a higher low and a potential higher high as the bullish structure continues developing. This is why it is so important to learn how to mark the trading range in real time, instead of only studying static examples after the move is complete. As price evolves, the trading range must also be adjusted according to the developing market structure. However, Within the ComLucro framework, the range only becomes fully fixed once price delivers a valid retracement, specifically reaching at least the 0.382 level, which is one of the criteria we use to define a valid pullback. At that point, the structure becomes more clearly established, allowing us to properly define the higher low and higher high on the chart. Until then, while price continues expanding upward, the trading range remains dynamic and adapts to the developing price action. Now, the same logic can also be applied in bearish market conditions. In a bearish scenario, the trading range is drawn from the swing high to the swing low using the Fibonacci retracement tool, with the 0 level placed at the swing low and the 1 level placed at the swing high. The area above the 50% level becomes the premium zone, while the area below becomes the discount zone. When looking for long trade opportunities, we generally want price to trade within the discount zone, assuming other factors support the setup. The deeper price moves into the discount area, the greater the potential risk to reward ratio becomes, especially when a stop loss is placed below the swing low and the target is positioned near the swing high. In bearish market conditions, traders typically look for short opportunities within the premium zone. The higher price trades into the premium area, the better the potential risk to reward ratio, especially when the stop loss is placed above the swing high and the target is positioned near the swing low. So far, we have defined direction through structure and refined location through premium and discount. But even when trend and location align, execution still breaks down. Traders enter too early, place their stops in obvious areas, and become the liquidity that fuels the next move. That leads us to the third question and the third rule, which is less about where you are right and more about where everyone else is wrong.
The third rule, I want to put my entries where the masses put their stops. How's that? On your way home, I want you to pass a building site. And on the building site, you pick up a brick. Okay? You take that brick home, and tomorrow when you're about to put on your first trade, you decide where you're getting in. Just before you press the button, you pick the brick up and you go, smack it against your head. That puts you into the present moment. And here's what I want you to do. Rather than buying the market at where you thought you were going to buy the market, put an order in at where you were going to put your stop and see how often the damn thing goes to your stop. Okay? So place your entries where the masses place your stops. And this is another thing I learned from Larry, is that the best trades occur when the masses have been stopped and trapped. So even if you don't get in at the cusp of the turn, if you can look back and see, just obvious on the chart, that lots of people would have bought there, and then the bloody thing went down again, nailed them, and then reversed. If you get in after those people have nailed, then you're in a much better place, okay? And of course, that's difficult because we're scared of missing out. At least I am.
What he is describing is not just psychology, it is mechanics. When traders are stopped out, their exits become the fuel for the next move. And those stops are not scattered at random. Loss aversion places them for you. You want the smallest loss you can justify, so you set the stop just beyond the obvious line, under the swing low, below the equal lows, past the trend line. And so does everyone else reading the same chart. Your stop is not a private decision. It is a vote cast in the same place thousands of other traders are voting. And that concentration is precisely what price is drawn toward. So to apply this rule properly, we must first understand where that liquidity sits. Static liquidity refers to specific zones in the market where a large pool of money is resting, such as stop losses or buy and sell orders. When a trader gets stopped out of a position, the market absorbs the funds associated with that stop loss. Recognizing a liquidity sweep pattern before the price reaches our point of interest is crucial. This pattern confirms the strength of our supply or demand area. We use liquidity sweeps as a confirmation factor. The idea is simple. The market requires liquidity for momentum. If the price doesn't sweep liquidity before a key level, it often uses that zone as liquidity to fuel its momentum. Static liquidity can be identified in various areas on the price chart, such as below equal lows and above equal highs, above swing highs and below swing lows. below or above dynamic trend lines and channels, inside order blocks, below or above support and resistance levels, in Fibonacci retracement levels, and near the daily candle's body and wick. Having a solid grasp of static liquidity zones reveals their profound impact on market price direction. Neglecting them can lead to substantial losses. Some of these zones and patterns are especially important as they are widely recognized by traders, attracting more stop loss and pending orders, increasing the likelihood of price moving toward them to absorb liquidity. Now that you know where liquidity is clustered and why price is drawn toward those areas, the final step is execution. Identifying stop zones is not enough. You need a structured way to enter after liquidity has been taken, with clear rules for timing, stop placement, and targets. What follows is that model in full, the core version first, and then 3 ways of combining it with smart money concepts. So during the analysis phase, we focus on 3 things: market direction, the latest impulsive wave, and the available room before price interacts with a higher time frame key level. The next step is trade execution. Here we wait for price to pull back and then apply the Fibonacci retracement tool from the beginning of the impulsive move to its end. We place a buy limit exactly at the midpoint between the 61.8% and 78.6% levels, which is the 70.5% retracement. Our stop loss is placed a few pips below the swing low. The final step is trade management and target selection. We know that when price reaches this higher time frame area, it is likely to act as resistance and push price lower. Because of that, our first target is set just before this level, often near the close of the highest candle. The same logic applies when trading a bearish scenario. So as you can see, this model relies entirely on basic price swings and retracement levels. At this point, some of you may think that trading cannot be this simple and still remain profitable. However, simplicity plays a crucial role in Forex trading. Your trading plan must be clear and straightforward, with mechanical rules that precisely define where your entry, stop loss, and targets are placed. By trading this way, you can rely on your backtesting results with confidence, knowing that emotions are removed from your decision-making process and that your tested results closely reflect real market conditions. Now, this was the core version of the model. We have expanded it further by combining it with multiple smart money concepts, including fair value gaps, market structure shifts, and multi-time frame entries, which we will explain next. We begin with the first type of entry by combining the optimal trade entry model with fair value gaps. Here we have a well-defined uptrend. Our objective is to wait for a pullback and enter a long position at a more favorable price. If price breaks below this level, the entire bullish scenario comes into question, as it signals strong bearish momentum. This defines our correction range, and by applying the retracement tool, we can clearly identify the optimal trading zone. Now, if we look to the left side of the chart, we can see that the most recent impulsive move has formed several fair value gap areas, one of which aligns directly with the optimal trading zone. When price retraces into these zones, they can act as support and potentially drive price higher. A more conservative approach, however, is to wait for price to retrace deeper into the third fair value gap and enter the long position there. This is because price may use the first fair value gap as a liquidity grab, trapping early long positions. In summary, combining the optimal trading zone with fair value gap areas creates strong supply and demand zones and offers a high-quality trading opportunity. So, we move on to the second type of entry by combining the optimal trade entry model with market structure shifts. Here, we had a long-term downtrend until price failed to form a new lower low, signaling a loss of bearish momentum. Shortly after, price broke through the supply level to the upside. This change of character indicates that sellers are no longer in control and suggests a potential bullish reversal. Once price breaks structure above the previous high, it confirms that buyers have taken full control, marking a complete market structure shift from a downtrend into an uptrend. At this point, we can begin looking for long opportunities to benefit from the emerging bull market. This leads to an important question. When should we enter a long position? Even though price has a strong probability of continuing higher, entering at a poor level could still result in a stop out. This is where price swings and ICT's optimal trade entry come into play. Our directional bias is bullish, and there is sufficient room for price to move before reaching the next significant higher time frame level, located above. We can now apply the retracement tool to the most recent impulsive move and place a buy limit at the 70.5% retracement level. Our stop loss is set a few pips below the swing low, and our targets are defined according to the trading plan. This is how we combine optimal trade entry with market structure shift concepts to execute a high-quality trade. However, it is crucial to remember that no matter how strong a setup may appear, the market can always behave differently. Risking an excessive amount on a single trade simply because the probability seems high is a poor decision. Trading involves anticipating future price movement, and the future is inherently uncertain. After a 50% loss, a trader must gain 100% on the remaining capital just to break even. In Forex trading, survival always matters more than short-term gains. Now we move on to the third type of entry, using a 2-time frame entry approach. In this trading setup, we use 2 different time frames to execute the trade. Most of our analysis is done on a higher time frame, such as the 1-hour chart, and then we zoom into a lower time frame, like the 15-minute or 5-minute chart, to find confirmation and execute the entry. Let me walk you through the process. On the 30-minute chart, we can clearly identify an uptrend. We apply the retracement tool and define the optimal trading zone. As discussed earlier, once price pulls back into the optimal trading zone, we shift our focus to a lower time frame to look for an entry trigger and execute the long position. However, on the lower time frame, this same pullback may appear as a short-term downtrend. Our objective then is to identify signals that show this lower time frame downtrend is coming to an end, allowing us to enter a long trade in alignment with the dominant bullish direction of the higher time frame. When we observe a clear change of character, it provides a valid signal to consider a long entry. In this example, we know the higher time frame trend remains bullish and price is trading within the optimal demand area. As a result, we have combined multiple price action concepts and confirmations to justify this trade. What you have seen in this video is not a collection of random strategies. It is one framework answering 3 questions. Direction tells you which side to take. Location tells you where that side is cheap. Liquidity tells you when the crowd has already paid for your entry. Pullbacks work because they align with structure and location, and the best entries form where stops are clustered and liquidity has already been taken. And now the first rule has an explanation. A good trade feels hard because all 3 answers put you where the crowd is not. That discomfort is not a warning. It is confirmation that you arrived early enough for it to matter. Confidence does not come from predicting the next candle. It comes from understanding why price moves and standing on the disciplined side of that split with a plan you can execute. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the ComLucro Trader Community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.